In this video, we will talk about whether having a rental property helps with your taxes. Hi, my name is Shyam Ganesh and I'm with Grow Your Wealth Financial Planning. A lot of investors and clients of mine will ask the question, if I bought a rental property, is that going to help me with my taxes? So the way I'll answer that question is kind of breaking it down into three sections. So the first way that it can help you save on your taxes is just all of the expenses that you incur in order to purchase and then to manage the property with a tenant in it, whether that's a longer term rental or a shorter term Airbnb, VRBO type rental. So what are some of those costs that you might have? Well, you have to advertise the property. When you purchase the property, you have to pay lawyers. You may have to do some repairs, renovations when you first purchase the place. You'll have property taxes on an ongoing basis. You'll have the home insurance that you need to purchase. And so these all help on your taxes in the sense that they will reduce your taxable income. So if you're collecting $3,000 in rent and you have $2,000 in collective expenses, then those are deductible. So only the difference, the $1,000, has to be declared as income, and that's what you pay taxes on. Now, there could be a scenario where you have a loss on your property. That is, you are actually collecting less rent than your actual expenses, in which case it would help you with your taxes. But is that a good thing that you are losing money on a property in order to help you with your taxes? Absolutely not. So you want to focus on keeping the property profitable, but making sure that you're claiming all the expenses that you can in order to keep your taxes minimal. So the second two ideas that I'm going to share with you are probably some of the key levers as an individual investor that you have in order to help manage your tax bill. So the second piece is what's called depreciation. And so if you buy a property that was built in the year 2000, by the time it's 10 years, there's some repair or drop in value of the physical structure, right? The property value itself might have gone up, but the roof is starting to get older. The structure is starting to get older. So there's a depreciation that you can apply on a property that you hold. The caveat is, and so that depreciation actually saves you money on your taxes. And I will say for all of these things, you should work with a qualified tax accountant so that you can get it right, do it right. But the caveat is, you'll save taxes on depreciation along the way. And if your property actually increases in value, which again, from an investment point of view, you want it to do, then when you go to sell the property, you will have to repay some of the taxes that you've saved. And so depreciation is a great tool for an ongoing tax deferral. So you're just putting off the taxes for a future day. And so if you take that tax deferral, you pay less tax today and you reinvest it effectively, then it's a strategy that can really work for you, and that's something you want to use. What you don't want to do is take the savings that you get from depreciating a property and just spend it on something that isn't earning a sufficient return, because you know that cash needs to be paid back in taxes down the road. So reinvest that money. That will help. And then the third lever that you have is what type of mortgage or financing you take on the place. So one of the many expenses on the CRA form T776 here in Canada is your interest expense. And that comes from a mortgage or a home equity line of credit. So if you take a traditional mortgage, you are making a combination of principal and interest payments. So what you'll need to figure out is how much of your monthly or biweekly payment is actually interest, and the interest amount is an expense that you can deduct, which means it's going to lower your taxable income. So choosing your financing carefully can also help you with minimizing your tax load. I would have you consider that what you really want in a property is for it to cash flow. So the higher the cash flow you can get out of the property, the more you have left over to reinvest in another property. And so, yes, there are deductions that you can write off on a rental property that you buy, but only as much as the profitability of the investment itself. So I wouldn't buy a property just to show a loss on it, because your savings in taxes is always going to be less than the loss or gain that you make. So those are the three categories of things that will help you, and choosing whether you amortize or depreciate at all, and the type of financing that you take are I believe, critical factors in determining your final outcome. If you have any questions, or if you'd like a template for analyzing your rental property or analyzing a property that you are about to buy, please click the link below, and we will send you a copy of our template that will help you get organized and calculate some of the returns that you can generate from a particular rental property. Thanks so much. If you enjoyed this video, please like, subscribe, comment, ask some questions, and we look forward to seeing you again on the next video.